You're in your early 40s, you make decent money, you've always made decent money, you cover your mortgage, manage the car payments, put something into the 401k. From the outside, you look fine. And then one night, a Tuesday, maybe a Sunday before a work week you're already dreading, you do something you've been quietly avoiding for months. You log into your retirement account, you stare at the number, the sum total of everything you've built, after 2 decades of work. And the number doesn't look like 2 decades of work. That's the moment this video is for. Not because you're in crisis. You're probably not in crisis. But there's a version of your financial future that quietly becomes fragile if the right systems aren't in place. And there's a version that holds. That doesn't break under the weight of a layoff, a hospital bill, a car that dies in the driveway, a kid heading toward college, or a parent who suddenly needs help. By your 40s, wealth is not just a number in a retirement account. It is the durability of your entire financial life. Your ability to absorb a hard year without the emergency restructuring everything around it. A good income doesn't automatically give you that. You can earn 6 figures and still be one bad month away from a spiral if every dollar already has a job before it arrives. You are not trying to look wealthy in your 40s. You are trying to become hard to financially knock over. That is what these milestones are measuring. The first one is the one most people avoid because actually looking is uncomfortable. You know your real retirement gap. The standard benchmark says roughly 3 times your annual salary saved by 40 and 6 times by 50. If you earn $90,000, that is $270,000 by 40 and $540,000 by 50. If your 401k balance is sitting at $95,000 right now, the gap is real, and it needs to become your project for this decade. The 401k balance is not judging you. It is showing you whether your past decisions are helping your future or just collecting interest on the past. Add up every account, your 401k, your Roth IRA, any old rollover IRAs from previous employers. Compare the total to 3 times your current salary. Write down the number. That is not a verdict on your life. It is a project. And the most powerful tool for closing that gap is not your investment picks. It is your savings rate. Someone consistently saving 20% of their W-2 income across their 40s is often in a dramatically stronger position than someone earning twice as much who saves almost nothing. Twice the income, 3% saver wins every time. 15% is solid. 20 is excellent. 25 puts you on an accelerated path. Whatever rate you are at, the mechanism needs to run automatically, so the decision does not have to be remade every month. Consumer debt in your 40s needs to be on a clear elimination path, not managed, not tolerated indefinitely. Start with credit card APR above 15 or 20%. There is no investment that consistently beats a 22% guaranteed return. The S&P 500 has historically averaged 8 to 10% annually. You cannot outrun a high credit card APR in the market. Trying to invest aggressively while carrying that balance is filling a bucket with a hole in the bottom and wondering why it never gets full. Car payments deserve their own line. The car payment fits fine until the roof leaks, your kid needs braces, and your company starts talking about restructuring in the same month. A financed vehicle is a depreciating asset paid for with money that could be compounding toward retirement. 2 car payments in your 40s is a very expensive way to bleed cash. Then the fixed cost structure underneath everything else. Keep housing at or below 25 to 30% of gross income. Mortgage, property tax, insurance. If housing and transportation together consume more than half your take-home pay, no savings rate fixes that. The person who controls their fixed monthly obligations has margin. Margin is what allows every other milestone in this list to work. A 3 to -6-month emergency fund in a high-yield savings account is not new advice. Here is what most people underestimate about what it actually does. Yes, it covers you if your job disappears, but it also removes fear from your ordinary financial decisions on a normal Tuesday. The person with a real financial floor is not white, knuckling it every morning wondering what happens if this job goes away. They have options. Options change how everything feels. By your 40s, the risks are broader than they were in your 30s. A parent who needs help, a health event with a deductible that resets in January, a layoff in an industry that rebounds slower than expected. Without a floor, a hard month becomes a hard year, and a hard year forces decisions you cannot undo. Rating your 401k early and paying the penalty. Taking on new debt at the worst possible time. That money sitting in a HESA is not lazy money. It is freedom money. 6 months if your income is stable, 12 if it is not. There is a difference between earning a good income and building real assets. By your 40s, you need both. Income is spendable, it feels like wealth. But if it walks out the door before it becomes anything permanent, you are not building a future. You are financing a very expensive present. You can earn a strong six-figure W-2 income and have almost nothing working for you in the background. Real retirement assets look like a funded 401k with an allocation that actually reflects your time horizon, not the one you set on day one 15 years ago and never revisited. A Roth IRA you contribute to every year. A taxable brokerage account for money you might need before retirement age. An HSA if you have access to one. Contributions go in pre-tax, grow tax-free, come out tax-free for qualified medical costs, and most people with access to one are not using it fully. The Social Security credits you've been building through your W-2 paycheck your entire career are real future income too. Your money needs to be working when you are not. Not sitting idle. Working. This next one is the milestone most people skip because it involves planning for things they do not want to think about. It is also the one that causes the most financial devastation when it gets skipped. Health insurance you can actually use, not coverage that exists on paper but leaves you exposed to an out of my pocket maximum you have not prepared for. One major uninsured or underinsured medical event can erase years of financial progress. It is one of the leading causes of serious financial hardship in this country. Disability coverage. Almost nobody thinks about it, and almost everyone needs it. Your income is the engine of your entire financial life. If that engine stops, an injury, an illness, a long recovery, the mortgage does not pause, the car payments do not pause, and your retirement contributions do not continue on their own. Most employers offer some form of it. Most people have never checked what it actually covers. Term life insurance, if anyone depends on your paycheck. A 20-year term policy does one thing. It pays your family if you die before it expires. The same coverage costs significantly more at 50 than at 40, and a health change between now and then can make it unavailable at any price. This is not a someday item. Your beneficiary designations on every account, your 401k, your IRA, your life insurance pass directly to whoever is named on the form, regardless of what your will says. If that name is wrong, your intentions are legally irrelevant. Check every account this week. And a will. 1 in 4 Americans has one. Get one. Lifestyle creep does not announce itself. It shows up as the slightly nicer car, the restaurant habit that became 4 nights a week instead of 2, the vacation that used to feel like a splurge and quietly became an assumption. And then you're earning $180,000 a year and still wondering where it all goes. Every time your income grows, your savings rate needs to grow with it. Not stay flat, grow. Your future self gets a raise every time you do. And by your 40s, the mechanism delivering that growth cannot depend on your motivation. Motivation is unreliable. It is strong in January and missing in March. It evaporates under stress, which is exactly when your financial life needs to hold. Your 401k contributions should come out before you see the paycheck. Your Roth IRA should fund on a date you set once. Your bills should pay themselves. By your 40s, financial progress is not about vibes. It is about systems. When those systems are running, savings rate consistent, floor built, real assets growing, protection in place, something starts to happen. Money begins buying back your time. The ability to say no to the project that would have consumed your entire weekend, to walk away from a job that is grinding you down because you have 6 months in savings and you are not trapped. The Tuesday morning you can show up for something that actually matters, without checking your account balance first. That is what financial durability actually produces, not just a number. Options. Here's where this lands. You may not be rich by the end of your 40s. That was never the point. The point is whether your financial life is durable, whether it can survive a layoff, a health event, a bad market year, a difficult family situation, without your entire life restructuring around the crisis. If these milestones are working, the retirement gap you are closing, the debt on an elimination path, the financial floor in place, the real assets compounding in the background, the protection layer set, the system running automatically, you are probably going to be okay. Not because every number is perfect. Because you are not fragile. Because you have built something that holds. You may not be rich in your 40s, but if these systems are in place, you are hard to financially knock over. And over the long run, that is what wins. The window is open right now. The math is still on your side. Make the decisions while it is.